Good evening, all. Welcome to this evening LVRC classes for a very important and relevant paper, that is CA Final paper number 5, which is for indirect taxes. Now, as we all know, this paper comprises of the chapter, the act relating to the GST, which we studied in detail, all the aspects of GST, right from the very basic concept of supply until the chapters relating to penalties, offenses, refund, and prosecution. Now, we are in the second part of our indirect tax law, which is customs and FTP. In our previous class, we did the substantive provisions of customs, which included the levy, which included exemption, which included valuation, and which included classification. Now today, we'll take up the procedural aspect of customs. Students, you need to be well versed with these provisions as they have a lot of relevance in your exam papers. So whenever we are dealing with the custom section, a good weightage is on this particular aspect of the customs, which we call as the procedural aspect. Now, why this procedural aspect is very important? Because the customs levy is on import, but when you see practically the application of the custom law, it is completely procedural driven. So whatever we study in levy, whatever we study in valuation, everything passes through the detailed procedural aspect of customs. Now, the first chapter that we are going to deal with today is this procedural aspect dealing with the import and export procedures. Now, let me give you a brief before we can go to the detailed provisions. So, whenever just visualize a vessel carrying goods and passengers is calling at an Indian port. Let us say a vessel starting its voyage from the UK is reaching the Mumbai port. Now, before the vessel can enter the port premises, it has to first seek permission with the port authorities for whether there is availability of space, because the vessel, once it comes to the port, may require 4 to 8 to 10 days or even month at the port. So it seeks permission from the port authorities that whether the port authorities are having sufficient space for this particular vessel to be berthed for that number of days. Now, once port authorities give them the clearance, then starts the role of the customs. Now, what is the purpose of customs? See, customs is one such law which has multifold purposes, as I also mentioned in my previous class when we started with the custom aspect. Here, I am putting it again, but in a different perspective. Here we are going to look at customs law from the perspective of one, revenue, that is collecting taxes, levying and collecting taxes. Two, imposing different types of restrictions, prohibitions, so that the imports and exports are properly regulated. So customs also play the role of screening. It is not only there for the purpose of duty collection merely. See, you can understand the sensitivity of this from the point that it is the borders of India. Anything going out without the knowledge, permission of the government and the authorities can be disastrous. Similarly, unwarranted things coming inside India, which may be prohibited, which are smuggled, may again be causing great damage either to industry or to the social fiber or to the safety and security of the country. Hence, it is very important to regulate all the imports and exports properly, which is one of the prime objects of the customs. So today we are looking at customs from the perspective of One, it is a revenue collection mechanism, a revenue collection point. If you recall my previous class where I said that it is a single window system, because through customs, we are not only collecting the customs duty, that is the import duty, but we are also collecting many local and domestic taxes and duties. Now, the second aspect, as I said, customs also play the role of regulator. So, customs being the first, you can say, firewall at the Indian borders, it is very, very crucial because its role is to ensure that neither any person nor any goods or documents or currency or any unlawful thing enters India. Hence, the second main purpose of the customs law is that of a regulator. There is another third angle to the customs. Customs is also, you can say, a regulator of trade. It is very important, students, to understand this point that the customs department, the entire customs machinery is not only for tax collection, but also for facilitating smooth flow of goods from India to outside and vice versa. And this is achieved by the entire custom mechanism, which includes inland container depots, which we call as ICDs, ICS. Then we have the various custom warehouses at the ports and near to your factory premises. So this custom machinery is also a very important medium or machinery for managing business, for managing trade. And a fourth angle, which if I can give you for customs, is that customs also act as that authority or that particular, you can say, government machinery, which is also involved in implementation of various government benefits and schemes which the government wants to implement for promoting international trade. So when you look at customs from these perspectives, you will see the expanded role, expanded importance of the customs in this whole picture. Now, keeping this in mind, I would like to tell you how this custom operates. So I was giving this example that a vessel starting from UK is calling at the Mumbai port. Now, before it enters the port, it has to take permission from the customs. So already port authority permission is done. It has to take permission of the customs. Now, when I say it has to take permission of the customs, it means it is implied that the vessel, and if you are coming by aircraft, the aircraft, or by any vehicle, whatever is your conveyance through which you are entering India or leaving India, which may be through sea, that is through vessel, ships, boats, etc., or through air, which will include aircraft, which will include different types of cargo planes, passenger planes, etc., and even vehicles, which includes truck, lorries, etc. So whatever is the medium of transport, according to that, there would be a conveyance through which that transportation is happening. Now, when you are coming by ship, aircraft, you have to take a permission from the custom authority even before you come to the port. This permission is very crucial because this permission is the permission from the custom asking them the permission to allow you to unload the goods and passengers which you are carrying. So when you are saying you are taking permission, it means the implied another condition is that you are calling at that port airport, which is a custom designated port airport. So an implied condition in the custom law is that whenever you are coming to India carrying goods, passengers, you should compulsorily land or call at that port airport, which is custom designated. That is where you have custom authorities for assessment. Now, for getting the permission from custom authorities, you have to submit something, which is a detailed record of the the goods, the passenger, your entire voyage log list from where, which ports, which countries you have traveled and coming to India. All these things are submitted to the customs in a proper format, in a proper document called as IGM. This document is analyzed by the customs, and when they find that it is good to go, they grant you that permission, which is called as permission of entry inwards. Now, when you listen to this word entry inwards for the first time, it gives you an impression that it is a permission allowing you to come in India, but that is not the case. It is the permission allowing you to unload your goods and passengers at the port. Thereafter, once you are given this permission, once you come, you berth the vessel or the aircraft lands, you have to unload it, the goods, the passenger, only at the designated places and under custom supervision. And then from there, the goods go to the custody, to the under the control of the custodian, who is at times the port authority. So interestingly, you cannot take the goods, the cargo immediately. It first goes to the custodian. Now you as an importer who is importing the goods has to file an application which is called as bill of entry in case of import and bill of export or shipping bill in case of exports. This application is seeking the permission from the customs to clear your goods. Now, at the time of import, when you are filing this document, you have to also do assessment, because now customs also has self-assessment. And through this self-assessment, you yourself have to compute the value as per our valuation chapter, compute the duty as per our types of duty chapter, and pay that amount, and then submit the final application for clearance. Now here you may be submitting the application for immediately clearing the goods, which is called as clearance for home consumption, or since the custom allows this facility, you may file an application, a bill of entry, asking custom to shift your goods from the port, which is Mumbai, to a custom bonded warehouse which is near your factory or your unit, let us say in Bhopal, in Indore, MP. So custom has this facilitation also, that you need not pay the duty immediately, but you move the goods from the port airport to this custom bonded warehouse where these goods can be stored until you require them. And whenever in future you require them, then you file the bill of entry for its final clearance and assessment is done accordingly. So this is how broadly the entire custom process for import happens. Similarly, for exports, you bring your goods to the port from where you want to export the goods. You file the shipping bill, you file the bill of export. Again, it is processed. The custom officer, if required, will do physical checking. And once everything is fine in order, rarely there is export duty, but if there is any, you are paying the duty. And after carrying out all the inspections and check, the customs will give you the let export order. After that, you can load your goods on the ship, and then finally the ship is given the permission of entry outwards, vice versa to entry inwards. So this is how the entire custom mechanism works in brief. Now we go to the details, and with this background in mind, I'm sure you'll appreciate each of the provisions. So first, since there are three modes of transport, hence first definition is of conveyance, which covers all the three mediums, that is vessel, aircraft, vehicle. Now interestingly, students, is the definition of importer and exporter. Now if I have to say who is an exporter, we will say ki exporter is that person who is exporting the goods, and generally we mean by that the owner of the goods. Interestingly, that is not how the customs law define exporter and importer. It is defining exporter and importer for a limited period, and it is dividing it comprehensively. Now, what is that limited period? It says in relation to goods at any time between their entry for export and the time they are exported. So The relevance of exporter is only between this period of time. That is when you are bringing the goods at the port and finally the goods are leaving India. This is the time span in which the exporter concept is relevant. Now, who will be exporter in this time period? It may be the owner or the beneficial owner or any person holding himself out to be exporter who may not be the actual owner. Now, this is interesting. Now, you'll say, sir, what are the meanings of this? So, owner, we understand the real owner. Beneficial owner is, see, at times the goods may belong to someone else. Someone else is having control over the goods, but on the face, on the front, someone else is kept. So the person who is doing documentation, etc., may be a person, but actual ownership may not be of that person, it would be of me. I am using that person as the face in front. Now, many times this is done. Now, this particular concept was added in 2017, the concept of beneficial owner, with the purpose of tracking the actual beneficiary of the transaction, because over a period government found that many times in relation to import and export, wherever any type of undue advantage or benefit is tried to be sought, the actual owner of the goods is not coming into picture. He's keeping someone else, a dummy person in front, who appears to be exporter, who appears to be owner, but the actual benefit of that transaction is going to someone else. So the person who's ultimately going to get the benefit of the transaction is called as the beneficial owner. Then comes the third person, any person holding himself out to be exporter, which simply means in case the actual owner doesn't comes up, then whoever takes the responsibility of doing the entire custom process of export, many times it is the CHA, that is a custom house agent. So that person will be treated as exporter for the purpose of this export. So if you see, the law is not actually concerned with the real owner. The law is concerned with one who is getting the benefit, and second, the person who wants to be treated as an exporter for that period and for those goods. Similarly, mutatis mutandis is the concept and definition of importer. Again, it says in relation to any goods between this time. What is the time? Between their importation, that is the goods coming to India, and the time they are cleared finally for home consumption, that is taken from the customs authority. Between this period, the person, one, who is the actual owner, will be treated as importer. Two, who is again the person who may not be on the face of it the owner. On the face of it, the owner may be somebody else, but this is the person who is getting the benefit of the transaction, or on whose behalf the actual import is being done. Only this, that this person is not coming in front. And then any person who wants to be treated as an importer. Now here again, it may be the custom house agent, or at times, if you recall our previous chapter, we had discussed that importer has the rights, the option to relinquish the title of the goods. Now, if the original importer, what I'm saying, yeah, if the original importer forgoes his title to the goods, if he relinquishes the goods, then whoever person comes in front and is ready to take up the responsibility and ready to clear the goods will be treated as the final importer. So this is how is the expanse of this definition. Now we come to a very important definition, that is the definition of foreign going vessel or aircraft. Now, what is this definition and what is the relevance? Let us understand. So again, as I mentioned, what is the purpose of customs law? Customs law is only not for collecting tax or duty. Custom law is also for regulating. Now, this particular definition is more from the perspective of regulation. Now, it is defining foreign going vessel as all the vessels which are leaving the Indian soil. So first, it will mean vessel aircraft which were engaged in the carriage of goods passenger within India and which are now going to leave India, whether or not they are touching any intermediate ports in India. So in short, any vessel, any aircraft which is going out of India and which is carrying passenger goods, first is this. Again, the purpose is tax collection also and also control. Second, naval vessels of foreign government. Now we see the news many times, many different countries, naval vessels come to our waters for doing some joint naval exercises. So whenever they are leaving India, we also need to keep a watch on them, that it should not happen that they have come to us under the pretext of taking part in naval exercise, and eventually it ends up that they are taking some military action against us. So even they are kept under radar, hence they are also covered in this definition. Then any vessels which is engaged in fishing or other operations outside our territorial waters. Now this is important. We have control on everyone who is within our territorial waters. But if anybody is outside our territorial waters, we may not have the complete control. Now in such cases, again, we need to be cautious. We need to keep a watch on these vessels, because they may be spies, they may be people trying to sneak into our country illegally, illegal migrants, terrorists. So we need to keep a watch on them. So they are also kept in the radar by putting such vessels in the category of foreign going, who are engaged, they are pretending to be engaged in fishing or other activities outside our territorial waters, but still we need to keep a watch on them. And then comes the residuary part, vessel aircraft proceeding to a place outside India for any purpose whatsoever. Now, this will even cover those vessels aircraft which are hijacked and taken outside. So that is why the expansion of this term for any purpose whatsoever is very wide. So vessels, aircrafts which are leaving India for whatever purpose, we want to keep a watch on everyone. Then comes the next part, which is person in charge. Now, what is the relevance of this? See, we need to have control. So tax collection is one perspective, and another very major perspective is control. But to have a control, we will have to put responsibility on someone. So when we need to put responsibility relating to the entry or exit of the conveyances, then the responsibility is put on this person. So you'll find in majority of the provisions in the procedures, whenever it is dealing with the vessel or aircraft, the reference is of person in charge, because all the responsibilities relating to the vessels and aircraft is cast upon this person. Now, simply put, who is a person in charge? So basically, person in charge is that person who is having control over the operation of that conveyance, who is having control on the movement of that conveyance. He is the one who decides where the vessel aircraft will go, where it will land. So that is what is the meaning of person in charge. Now, now, with this backdrop in mind, let us analyze. So, person in charge for a vessel will mean what? The master of the vessel, because this person has the complete control on the movement, on the operation of the vessel. For aircraft, it is the commander or pilot in charge. For railway train, it is the conductor or guard having the chief direction of the train. And for other conveyances like trucks, etc., it is the driver. So basically, it is that person who has the control over the entire movement of that particular conveyance, so that we can put different responsibilities that you will see in the various procedural sections. Now comes another important definition. See, I had said that whenever a vessel is coming to India, it seeks permission from the customs, which is called as entry inwards permission. That is a different term. And this term entry is a different term. Now here again, when you read the word entry, the first impression that you get is entry means entering. Again, that is not the meaning. Here, entry means the noting done in any document. So whenever you are making a noting of any transaction, like how we say you pass a journal entry, it means you are noting a particular transaction in your books through journal entry. That is what is entry over here. Entry means the noting. So what it means in relation to goods, it means an entry made in one of these documents. So making an entry, noting a transaction in the document is entry. Second, It includes entry made under the regulations made under section 84, that is with respect to post or courier. So whenever you want to do import export, you are using one of these documents. So noting your goods in that particular document is what is entry. Now we start with the procedural provisions, which contain some conditions, contain some restrictions, and these are very, very important for your exams. Now, the first or the very first condition being put is under section 29. This condition is put on the person in charge. What is the condition put? That whenever they are coming to India, then they should only come to that place which is designated as custom port or airport. So whenever they are coming to India for the first time and they are carrying goods or passengers, they should compulsorily come to custom ports airport. In case you do not follow this, you will be penalized because it will be an attempt to smuggle goods or attempt to bring illegally people into India. So the first condition is on the person in charge is that whenever the person in charge is entering India, whenever a vessel aircraft is entering in India from any place outside India and it is carrying passenger or goods, it should compulsorily come to a custom designated port or airport. Now, exception to this rule provided in the law itself is that it may land at any other place, but when it is compelled by accident, stress of weather, or other unavoidable causes. So, when it will be allowed to not come at custom port and land at any other place, whenever it is proved that or it happens that there is some accident, some mishap, or because of weather conditions, it was forced for the purpose of safety of the crew, of the passenger, and also of the entire plane, etc. It was compulsory for them, and there was no other choice but to land at a place other than port airport. Then they are allowed to do that. But again, this relaxation comes with some additional obligations. Now, whenever you are landing at a place which is not a custom designated port airport, then the additional condition put upon you is that in this particular case, you will have to immediately report your arrival to the nearest custom office, if any, or if not, then the nearest police station and produce the logbook of your aircraft. So whenever you are landing, whenever you are falling at a place which is not custom port airport, this is the first responsibility. Then only when the officer permits, you should unload the goods, the passenger, the crew. Only then they are allowed to deboard and the goods are allowed to unload. Now again, this has an exception. Goods can be unloaded or passengers can leave even without the consent of the officer when it is necessary to preserve health, safety, or life. So let us say the plane is about to catch fire or the ship is about to break and sink. In such cases, the person, the goods may be allowed to unload. Further, they have to comply with all the directions given by that custom officer or police officer. So first obligation is coming to a custom port airport. Now, as I mentioned at the start, you have to take the permission of entry inwards. And for getting this permission, you have to first submit an important document called as the arrival manifest or the import manifest or the import report. Now, what is this arrival manifest or import report? So basically, it is a document which contains details of all the goods that you are carrying. It contains details of the places from where you are traveling and reaching Indian port. Now, this is again very crucial. First, what you are carrying, we need to check that from the perspective of health, safety, security, plus The places from where you are coming, again, we have to see whether these places are put in the red or the prohibited list, or they are put under radar, or if any passenger who is traveling and your ship is coming from a particular place or your aircraft is coming from a particular place, whether there is any red flags given. So in order to ensure that all these things are checked, the condition is that the person in charge has to first produce this document. Now, in relation to vessel and aircraft, it is produced electronically and it has to be done compulsorily prior to arrival. In case you are coming by vehicle, you can do it prior or within 12 hours after your arrival, and the manner may be manual or electronic, that will be prescribed. Further, the principal commissioner or commissioner may allow these documents to be delivered in other manner if not feasible. So this is for giving relaxation. In case you fail to comply with these provisions, there can be penalty up to 50,000. Further, if the proper officer is satisfied that the document that you produced is either incorrect or incomplete, but there was no fraudulent intention, they may allow you to amend it. So now students, make note of these points. These are the specific questions that is asked relating to this particular chapter. Now, similar to import manifest, you are also required to give list of passengers and crew. So it becomes your passenger and crew arrival manifest. This covers the passenger related details, so that again, if there is any passenger who is blacklisted from entry into India, or which is put in any national or international agency's radar, so that can be identified. So person in charge or any other specified person has to deliver this to the proper officer. What? The passenger and crew arrival list before the arrival in case of aircraft vessel and upon arrival in case of vehicle. And what it will contain? It will contain the passenger name and other information. Now, means records prepared by operator is authorized agent or any aircraft vessel vehicle for each journey booked by on behalf of the passenger. Fine. Again, non-compliance of this may lead to a penalty up to rupees 50,000. Next, imported goods not to be unloaded from vessel until the entry inwards permission is given. So once you submit both these reports, import manifest and the passenger manifest, then the customs, after checking both the records and finding that goods and passengers both are allowed to be brought into India or allowed to enter India, then the customs will allow you this permission, which is called as permission of entry inwards. And only after getting this permission, the master of the vessel will allow unloading of the imported goods and also allow the passengers to deboard. Without this permission, it is not allowed. Next, this order will be given only if the arrival manifest or report is delivered or proper officer is satisfied for valid reason of non-delivery. Now, exceptions: unloading of baggage accompanying passengers, crew members, mail bags, animals, and perishable or hazardous goods. So for unloading these, they may not wait for this particular entry inwards. They may be unloaded, and in the meantime, the entry inwards can be processed. Next, imported goods cannot be unloaded unless they are mentioned in this report. See, again, try to link all these points. So we are first asking you to come to custom airport port. Second, we are asking you to first submit the details of what you are carrying for the for India. That is what you are going to unload. And then this condition says you will not unload those goods which are not mentioned in the import manifest. So see, within import manifest, you have categories that these are to be unloaded at India. These are to be carried forward. These may be supply and stores of the ship, which will be there always with the ship and aircraft. So you categorize the goods accordingly. Now, what this condition requires is you will unload only those goods at the Indian port or airport which you have specified that these are meant for Indian port or airport. Next, loading unloading of goods will happen only from the approved places and not any other place. Next, again, the loading unloading will happen only under the supervision of the customs officer Again, exception is the board may either give general permission or it may give special permission where this may not be followed. Now comes another very important point for exams. Now there are two types of questions that may be asked. First is restrictions on goods being waterborne or boat note procedures. Now what exactly is this? Goods being waterborne. It simply means that in some special cases, the customs will allow that you carry the goods in water, or in other words, you carry the goods through small ships and boats. Now, what is this and when does this happen? So let me inform you, dear students, we have multiple ports in India. Now, this will happen mainly in case of sea transport. Now, at many ports, the water near the port is very shallow. It is not deep. Because of which huge ships which are carrying goods may not be able to come to the port. They have to be berthed somewhere in the deep sea where the water is sufficient so that the ship is not stuck up in the water or the lower land soil. Now, since these are huge ships, they also run into deep into the waters. So that is why there is some minimum depth of the water required till where the ships may come. Now, many times, as I said, many ports of India are not having sufficient depth. So these huge ships, they cannot come to the port. So they have to wait somewhere far off in the waters, from where the goods will be brought to the port, and the goods from port will be taken to the ship either by carrying them on the head if the water is so shallow that people can walk in that, or they will be carried through small boats. Now, in such cases, when this has to be done, there are some specific rules and regulations to ensure that the goods are not drifted away, they are not smuggled. That is what is section 35 putting, where they say restriction on goods being carried in water, waterborne being carried in water, and how it is done through this boat note procedure. So what it is, so wherever either import of goods or export of goods is happening, but the vessel cannot come to the port because of the shallowness of the water. In such cases, the goods have to be carried in water. Now, the condition given in section 35 is they will be carried in water, but for that they have to be accompanied by a boat note. Again, the board will give general permission or there can be special permission. So only those goods which are specified in this permission can be carried through water through this boat note procedure, right? Now comes assessment. Now in assessment, there are two assessments. One is section 17, one is 18. We are first seeing section 18, which is provisional assessment. Now what is this provisional assessment? So many times where section 17 requires you to do self-assessment, you may find it difficult to assess it yourself. Why? Because the exact rate, the exact value, you may not be able to determine. So you yourself are confused about what will be the correct rate value exemption. In such cases, this section 18 gives you a special method whereby you can approach the customs officer and you can ask the custom officer to do your assessment. Now, since your goods, obviously when they are new or they are something happening for the first time, hence you are not able to determine its rate value, the same problem may be there with the custom officer. But this section empowers the custom officer to determine your value on provisional basis, that is temporary basis. So officer will determine the rate value on temporary basis, give you that rate value, you do your assessment applying that rate value, and also you furnish a security. so that if later on it is found that this assessment or valuation was less, they can recover the difference. Now, in this particular case, the officer will issue you this particular provisional assessment details, and following their details, you will make the assessment, you will pay the duty, and you will provide more details to the officer to finalize the assessment. The assessment has to be finalized by the officer maximum within 2 years, which may be extended by the commissioner as per the requirement. In some specific cases, which has to be specified, the delay may be condoned by the commissioner. Now, the important point is when you are doing assessment using the temporary rates and value given by the officer, in case after the final assessment is done, it is found that the amount of tax you had paid was less. Now you will pay the difference along with interest, but there will be no penalty because you had already taken the rate value given by the officer. Then secondly, in case the tax which you had paid is higher, in that particular case, the excess tax would be refunded back to you and there will be no interest on that particular thing. That is what is provisional assessment. Then comes voluntary revision of entry post clearance. Now, what is this voluntary revision of entry? So you had already done assessment, and after you clear the goods, you find or you come to know that no, there was some mistake in your original assessment. Now, this section allows you to carry out a revision in your original assessment. So this says that importer or exporter may revise the entry, whatever they have done post their clearance. Duty is self-assessed based on this revised entry. If earlier duty was paid less, you will pay the difference. If it was excess, you will claim refund. Proper officer will check the revision, and duty is reassessed if self-assessment is incorrect. So when you do this, whenever your first original assessment had gone wrong. Now, so briefly, what is the entire import procedure? Goods should land only at the custom approved stations. You file the request for entry inwards, which is after giving this document of import report or import manifest. You are allowed the permission of entry inwards, which is the permission to unload. Only after getting this permission, you can unload the goods, which will happen under custom supervision at approved places. And on working days, if you want it on vacations or holidays, you'll have to seek special permission and pay extra duty. Duty means fees. Then the goods will go under the custody of the custodian, who is generally the port trust authority. Now, importer will be filing the bill of entry, which is either for immediate clearance of goods, which is home consumption, or for sending it further to other port, which is transit or transshipment, or for transferring it to a custom bonded warehouse. In that case, you can do it without making the payment of duty today. Now, in this particular case, whenever you want to clear the goods, you will again file bill of entry, which is now for home consumption. You will have to do self-assessment, and on the basis of self-assessment, pay the duty, provide the details, and the officer will allow clearance or removal of goods for home consumption. Similarly, in case of export, what is the procedure? The exporter who wants to export the goods will file the shipping bill or bill of export, which is done electronically. This goes to the officer. The officer will grant written order permitting the conveyance to leave the custom station. But before that, the custom officer to whom this application has gone, if the duty is payable, it is assessed. If proper officer is satisfied that the goods entered for export are not prohibited and exporter has paid duty, if any, then the proper officer will pass the order permitting clearance and loading of goods for exportation. Next, goods are loaded in the conveyance on for export with the permission of the person in charge. Now, in case the officer finds that there is some problem, the officer may seek further clarification, and only after you giving the proper clarification will allow the goods to be exported. Once all compliances are made, the officer will give the let export order. Now, students, in import, there is one important category, which is the category of baggage. Now, what is baggage? The baggage is your personal luggage. So, whenever you are going outside India or coming to India, as a passenger, you will definitely have some luggage with you. This luggage may either travel along with you or it may come before or after your arrival and departure. So baggage also includes unaccompanied baggage. That is the baggage which did not come along with you. Now, whenever you are coming to India and you are carrying any baggage or it is coming separately, which is unaccompanied baggage, the question is, will there be any customs duty? So answer to that is found in the custom provision, which says that firstly, the baggage will be treated at par with other goods. So you have to follow all the custom provisions. But there is a relaxation given, which is called as a general duty free allowance, whereby your baggage up to a certain extent is allowed duty free. Now, to what extent the baggage is allowed, that depends upon one, the category of the person who's coming, that is whether the person is of Indian origin, whether the person is a passenger or a tourist, etc. Second, the country from where the person is coming, and third, what is carried in the baggage. So depending upon these three things, the baggage rules have provided some general duty free allowance, that is up to this extent there will be no customs duty. Now you will have to learn this particular table because students, you are asked questions on this particular table. So first category of person is Indian resident or even foreigner who is residing in India, or a tourist who is coming to India who is of Indian origin, excluding infants, coming from any country other than Nepal, Bhutan, Myanmar. Second, tourist of foreign origin, excluding infants, coming from any country other than Nepal, Bhutan, Myanmar. Now, for both these, what is the duty free allowance? For the first category, the duty free allowance is up to 50,000. For the second category, who is tourist of foreign origin, the duty free allowance is up to 15,000. Third category is Indian resident or foreigner who's residing in India or a tourist excluding an infant and who is coming from these three countries, Nepal, Bhutan, Myanmar. For them, it is up to 15,000 and arriving by land, then only up to the UPE. What is UPE? UPE is where is the full form gone? 1 second, students. Where is the full form gone? UP is the use personal effects. Now, what all things are allowed in your baggage? Use personal effects, travel souvenirs, and articles, excluding the articles which are covered in Annexure 1. Either it should be carried on the passenger or in the accompanied baggage up to this value. So whatever you are carrying up to this value will be exempt. Now these should be your use personal effects, travel souvenirs, that is some gift or something you are carrying, or articles that you are bringing along with you, excluding Annexure 1. Next, infant passengers, only use personal effects are allowed duty free. The general duty free allowance of a passenger cannot be pooled with the general free allowance of any other passenger. It means if I am giving one passenger 50,000 and let us say three of you are coming, we will not apply the limit taking it as 150. That is why you have to divide the luggage between three persons in such a fashion that you get the maximum benefit of 50,000. Otherwise, you'll lose that benefit. Now, when you are carrying jewelry with you, what is the allowance for jewelry? So a passenger who's residing abroad for more than 1 year and coming from any country is allowed jewelry in case of men up to 20 grams up to the value of rupees 50,000, and in case of lady passenger up to 40 grams with a value cap of rupees 1 lakh. Now students, please note this category. This is very important. Out of all the parts in baggage. This is one of the most commonly asked part. Transfer of residence. What is this? So you have been staying out India for a considerable period of time, and now you are shifting back your residence to India. That is where it is called as transfer of residence. Now, whenever you are shifting back, obviously, at the time of shifting back, there would be more goods that you will be carrying. So here the duty-free allowance is slightly higher. Now, how much higher, that depends upon for what period of time you are staying outside. So you are staying abroad for 3 to 6 months, 6 months to 1 year, 1 year to 2 years, and beyond 2 years. In all these three cases, the value of duty-free allowance is 60,000, 1 lakh, 2 lakhs, and 5 lakhs. But there are a lot of conditions. First, what will be covered in this list? Again, personal and household articles, other than those mentioned in Annexure 1, 2, including Annexure 3 articles up to the aggregate value of this. So this is the value. Allowed, you should be Indian passenger. In this case, you should be Indian passenger and should not have availed this concession in past 3 years. And here in this last category, you should have stayed for minimum 2 years abroad immediately preceding your date of arrival. In case you have stayed for less than 2 years, the shortfall up to 2 months can be condoned if early return is on account of terminal leave, vacation by passenger, or any other special circumstances. So for the last category, your minimum 2 years period is having a relaxation up to 2 months. So you can come 2 months early before the end of 2 years. Further, total stay in India during this 2 years period, if you are coming to India for some visits, it should not exceed 6 months. Again, the principal commissioner or commissioner may condone short visits in excess of 6 months for special purposes or special reasons. Further, the passenger should not have availed this concession in last 3 years. It means if you have shifted earlier few years back to India and taken the similar concession, now the second shifting should not happen within 3 years period. Otherwise, you will not allow this relaxation. Now on lines with passengers, even the crew members are carrying baggage. So their baggage is also given some relaxation. What is that? Baggage rules also apply to crew members engaged in foreign going conveyance for importation of their baggage when they are finally paid off on termination of their engagement. However, other crew members of vessel and aircraft are allowed to bring items like chocolates, cheese, cosmetics, and other petty gift items for their personal or family use up to the value of 1500. Now, these are the goods which are covered in Annexure 1, 2, 3, and they are referred in various rules. So which rules are having relevant reference to this? That is also written. So Annexure 1 covers firearms and their cartridges not exceeding 50, cigarettes up to 100 sticks, cigars 25, and tobacco 125 grams, alcohol or liquor wines up to 2 liters, gold, silver other than ornaments, that is raw gold, and flat panel LCD LED plasma TV. Annexure 2 covers color television, video home theater, dishwashers, domestic refrigerator up to 300 liters, deep freezer, video camera, cinematographic films up to 35 mm, and gold, silver other than ornaments. And then Annexure 3 covers VCR, PCDP, digital video, disc players, music system, air conditioner, microwave ovens, word processing machines, fax, portable phototyping machine, washing machine, electrical LPG cooking range, personal computer laptops, and domestic refrigerators not exceeding 300 liters. Now, as I was mentioning, baggage also covers unaccompanied baggage. Means the same above relaxations are applicable to unaccompanied baggage, treating it as your baggage, provided some conditions are fulfilled. What are they? Above provisions are also applicable to unaccompanied baggage unless excluded if unaccompanied baggage has been in possession of the passengers and is dispatched within 1 month of his arrival. So if the baggage is coming later, it should come maximum within 1 month. Similarly, the baggage can also land in India within 2 months of your arrival. So if the baggage is coming before you, it should come not more than 2 months from your arrival. So if the baggage is coming today, from today, you should arrive in India in 2 months. However, if passenger is not able to come to India in 2 months due to circumstances beyond the control, the AC or DC may extend the period of 2 months up to 1 year. Most important, the owner of the baggage is required to make a declaration, which is called as the baggage declaration form, of the contents to the proper officer of customs for clearing it. Duties payable on such baggage at the rates in force at the time of declaration. Presently, the rate in force is 35%. Fine. With this, we complete the first topic for the day. Now we have to go to the second very important procedural part, that is warehousing procedures. Just give me a minute, students. Yes, students. Now go to the second part in procedures. Now, as we saw in the first part, when your goods are imported at the port of import, so in my example, it is the Mumbai port, you can either file the bill of entry for immediately clearing the goods, which is called as clearance for home consumption, or you can file the bill of entry for asking the customs to shift the goods from this port to a warehouse, which is a custom bonded warehouse. And this warehouse may be near to your factory within your city premises. Now, this is what is called as the warehousing provisions. Now, these custom warehouses are what? So either they may be public warehouses or they may be private warehouses. But in both cases, they are called as custom bonded warehouse because the goods are allowed to be kept here without payment of customs duty upfront. So my goods have been imported at the Mumbai port. I am asking the customs to remove it from there, to clear it from there and shift it and keep it in their own warehouse, which may be public or which may be private. Now, in both these cases, or rather all the three warehouse, my advantage is that today I do not have to pay upfront any duty for depositing the goods in these warehouse. The duty will be payable only when I clear the goods from these warehouse. Now, what is the difference between a public warehouse and a private warehouse? So public warehouse is the warehouse which is run, managed by the government, and here goods of any importer will be stored. Private warehouse is the warehouse of a particular importer who has got it licensed from the government, and over there mainly the goods of that importer only would be kept. Now, adding to this, a third category has been introduced, which is special warehouse. What is a special warehouse? So special warehouse is a warehouse which is notified by the CBIC where some sensitive goods are kept. Hence, it is a special warehouse. Now, in case of the first two warehouse, which is a public warehouse or a private warehouse, the control is record based. So there is no physical control. However, in special warehouse, since sensitive goods are kept, it is under the physical control of the customs. So it is under the lock and key of the customs. Now, in order to deposit the goods in warehouse, either of the two, the process is at the port of import. So in my example, the goods have come at the Mumbai port. I will file the bill of entry and I will tick in that bill of entry for warehousing. So in this particular case, I am informing the customs that I'm clearing the goods from this port, but I want these goods to be shifted to your warehouse, which is a custom bonded warehouse. Now, why is this custom warehouse of customs called as a custom bonded warehouse? Because in order to keep the goods in the warehouse, you have to not pay the custom duty upfront, but you have to give them a bond along with the security. And the value of this bond is 3 times of the custom duty assessed. So at the time of import, in my example at the Bombay port, when the goods had come, when you file the bill of entry, you make assessment of the goods. Let us say the duty comes to rupees 20 lakhs. You don't have to pay the duty. You have to give them a bond along with security of rupees 60 lakhs, which is 3 times the customs duty involved. Now, why to give this bond of 3 times the custom duty? The reason is they want to cover one, the duty which will come in future, plus the interest, plus the warehousing charges, and any other charges like if there is any default at your end, so penalty, etc. So to cover all these amounts, the law provides for taking a bond with a value which is equal to 3 times the customs duty. Now, this bond is given by the importer, and when all the formalities and documentations are complete and the officer is satisfied, he will pass the order of shifting the goods from the port to the custom bonded warehouse, which may be within your city limits where your factory is. Now, the bond which you are giving may be two types. It may be bond given for each import separately, or there may be a general annual bond. Now, when you're giving bond for each import separately, so every import happens like your first import has happened, duty involvement is 20 lakhs, you multiply it by 3, you get 60 lakhs, you give a bond with 60 lakhs value of security. Again, another import happens. Let us say the duty component is 1515 lakhs. You give a bond 3 times, which is 45 lakhs. So every time import happens, you have to give a separate bond. This is what is the bond, which is a consignment wise bond. As against this, the regular importers, what they do, instead of every time issuing a separate bond and running the whole process of creating the bond, they issue a lump sum bond at the start. So let us say the importer has given a bond of 100 lakhs at the start of the year. Such a bond is called as a general bond. Now, what will happen? The first import happens and the security amount is, let us say, 40 lakhs. So the bond had to be executed for 40 lakhs, which is, let us say, thrice the duty amount. Now, what this importer will do, since he has already given a bond of 100 lakhs, he will ask the custom to debit this 40 lakhs from that 100 lakhs bond. Again, another import happens in few days and the duty, the three times of the duty comes to 50 lakhs. Again, he will ask the custom officer to debit this bond with 50 lakhs. So out of 100 lakhs, 90 lakhs are debited. Now in future, whenever he will clear, let us say he clears the first consignment, he pays the duty applicable at that time. So now he had utilized 40 lakhs out of this general bond. So now 40 lakhs will be recredited to the bond. So it is like a passbook where whatever you are utilizing from this bond, that will be debited. And whenever in future you will clear the goods from the warehouse by paying the duty, you will credit that much amount. So this becomes a running bond and it ease out your process of the giving warehouse bond. Now, students, what is very important in this is this portion for your exams. When you are depositing goods in warehouse, until what time your goods can be kept in the warehouse? So first is the warehousing period. What does the law provides? Goods for use in any warehouse where manufacture or other operations are permitted under section 65. So we study a separate provision under section 65, which is called as manufacturing within the warehouse or bonded manufacturing. Now, this is the case where you are importing raw material, you are carrying out manufacturing within the warehouse with the permission of the customs, and the final product you are exporting. So, where your import is of raw material and export is of final product, instead of bringing that raw material to your factory and again finishing and sending back the final goods, it may increase your logistic cost, it may unnecessarily increase the time. So instead of that, you may make a small setup in the custom warehouse only for carrying out the manufacturing. This is what is the permission under section 65. Now, if you are doing this manufacturing operation within the warehouse as per section 65 provisions, then whatever capital goods you are keeping there, there is no time limit. So they may remain in the warehouse till the clearance. Similarly, other goods, that is raw material or other consumables that you are bringing in this warehouse, they may remain in the warehouse for period till its clearance. So in short, whenever the goods are brought in the warehouse or kept in the warehouse to be used in the manufacturing operations, there is no time limit. For all other goods, like you had imported the goods and now you want to take the goods to your factory. So in all other goods where you are not carrying out manufacturing operation within the warehouse, the time limit for keeping the goods in warehouse is 1 year from the date the order permitting the deposit in warehouse was passed. So you can keep the goods in warehouse for 1 year. You need to clear it within 1 year, or if any time extension is granted within that period. Now, students, besides the time period, the second very important point of this chapter for your exams is interest. Now, importantly here, for using the goods in warehouse for manufacturing operations under 65, there is no time limit. And for other cases, the time limit is 1 year. So law permits you to keep the goods up to this time. However, what is important is interest. Interest will trigger from a specific date. What is that period and what is the rate of interest that you need to understand? So first, capital goods and other goods for use in warehouse where manufacture or other operations are permitted. So again, the first category. So why you are keeping the goods in warehouse? Because you are carrying out manufacturing operations in the warehouse. Here, the rule is there is no interest payable. So no interest is triggered in this particular case. And for whatever time you are keeping the goods in the warehouse, there is no interest. Now coming to the second category where the time limit was 1 year. Now here, the interest will trigger once your goods are kept in the warehouse beyond 90 days. So for first 90 days of warehousing, there is no interest. From 91st day till the date you are removing the goods, there will be interest. The rate of interest is 15%, and the amount on which the interest is calculated is the final duty that you have to pay at the time of clearing these goods. The interest counting will start after the expiry of 90 days. So as I was saying, it will start from 91st day until you clear the goods. So let us say you have kept goods in the warehouse for 145 days. You are allowed to keep it up to 365 days, that is 1 year. You are removing the goods after 145 days. In such cases, let us say the duty payable is coming to 2 lakhs. Now you will pay the duty of 2 lakhs plus you have to pay interest. The interest will be calculated on this 2 lakhs at the rate of 15% multiplied by. Now 145 minus 90. What is the extra period you have kept the goods? 55 days. So 2 lakhs into 15%, now 15% is per annum. So divided by 365 multiplied by 55. This will be the interest that you will have to pay. I hope this is clear to all students. Now, till the time your goods are in the warehouse, what all things you can do with the goods? That is what is called as owner's rights. So I can inspect the goods. I can ensure that the goods are not getting deteriorated or damaged. So for this, I will change the packing wherever required. I'll do some treatment on the goods to preserve it and to prevent it from damage. Then I can do sorting. And last, I can even bring in customers to show the goods for sale, or there is also a provision whereby I can withdraw samples so that I can show it for sale. Then come students, the point relating to section 65. Now, as I was explaining above, what is section 65 dealing with? Section 65 of the Customs Act allows you to carry out manufacturing operations within the warehouse. Now, when you are carrying out manufacturing operations within the warehouse, so let us take an example. You imported raw cotton yarn and you are going to make shirts and trousers out of that. So your manufacturing is making shirts and trousers from the raw cotton yarn. Now, when you are going to manufacture these shirts and shirts and trousers from this cotton yarn, you have taken the special permission of the customs under section 65 to carry out these operations within the custom bonded warehouse. So you are given a designated space in the warehouse from where you can carry out these manufacturing operations under section 65. Now the question is, what is the treatment? Treatment of what? Treatment of the waste which is arising in the manufacturing process in relation to these goods. Now, what will be the treatment of waste depends upon what you do of the final product. So I had imported yarn, and from the yarn I am making these shirts and trousers. Obviously, while making that, there would be cuttings and other waste materials coming out. Now, what I have done of these finished products, that is the shirts and the trousers. So the first possibility is whole or part of the goods resulting from such operations are exported. So I have exported these shirts and trousers. So finished goods I have exported. Now, interestingly, students, you had imported raw yarn. You have made shirts and trousers out of it, and you are exporting these shirts and trousers. Interestingly, there is no import duty on the yarn which you have used in making these export goods. Why? Because until you clear the yarn from the customs, that is till the time the yarn is in the warehouse, there is no customs duty applicable, as we have seen from the previous chapter also. Now, since you have exported the goods from there, effectively, in the eyes of law, you have not brought the goods in India at all. So there is no import duty on yarn, there is no export duty on the goods exported. But the waste which is left after this processing, what is to be done of that? Now, since you had exported your final product, the law is giving you remission of the import duty on this waste, provided the waste is destroyed on whatever is waste is left, you are not removing it, you are destroying it. But if you want to take the waste, that is, you want to remove the waste, then you will have to pay the duty. But what is the provision? Import duty is remitted, it is waived. Since the final product is exported, so as I said, na, in the eyes of law, it is as good as you have not brought the yarn into India. But then the import duty will be waived, provided you destroy the waste, you don't take it into India. Second, if you want to take the waste into India, then we will treat it as import of waste and you pay the customs duty. Second possibility is the whole or part of the goods resulting from such operations are cleared for home consumption. So these shirts and trousers that you have made in the custom bonded warehouse, you are not exporting it, you are bringing it into India, you are clearing it into India. Now, in such cases, since you are clearing the goods into India, custom duty is chargeable both on these shirts, trousers also and on the waste also. Then comes another provision, removal of goods from the warehouse. Now, when you have kept the goods in the warehouse, you can transfer the goods from one warehouse to another. You can clear it within India, which is called as clearance for home consumption. This is on payment of tax. And third, you can also export the goods directly from the warehouse. In the first and third case, there is no duty implication. In the second case, there is immediate duty implication. Now, while your goods are stored in the warehouse, there is a possibility that there could be reduction in the quantity of these goods. Why? Because your goods are volatile in nature. Now, because they are volatile in nature, they may get evaporated, they may get extinguished naturally. In such cases, let us say you had imported 100 kgs of a particular commodity, and while removing from warehouse, it is 96 kgs. Now, the question is, for these 4 kgs, whether you will be required to pay the tax, because you are actually clearing only 96. So the answer is you will be required to pay tax only on the 96 which you are clearing, and the tax on that 4 kg will be remitted. But this remission is allowed provided it was a natural loss and it is within a reasonable limit as allowed by the proper officer. So this is what is the condition relating to remission. I hope this is clear to you all students. Let us proceed further. Now, the next point that we are taking up is the topic of refund. Now, students, we come to the topic of refund. Now, first question is, who can claim refund? The answer is eligible person can claim refund of duty and interest. Now, who is eligible person? The person who has paid the duty which is found to be excess, and importantly, he has not passed on the burden, so he has himself borne the burden. So I am importer, I have purchased or imported the goods. At the time of imported, I pay some import duty, and later on it is found that either the goods were exempt, hence the whole duty was not payable, or I had paid it at the wrong rate, which is a higher rate. Most important, If I have further sold these goods further, it means the law presumes I have passed on the duty burden, then I am not the eligible person. But if I have not further sold these goods, then if I've consumed the goods and they are with me only, then it is treated that I am the person who has borne the duty burden and hence I can take the refund. Now, what is the time limit for filing refund application? In general, it is 1 year. And if the duty is paid under protest, then there is no time limit for filing the refund application. What is the minimum amount? The refund should be exceeding rupees 100. If the amount of refund is less than 100, it will not be processed and allowed. Now, in relation to refund, a very important principle is of unjust enrichment. What is this unjust enrichment? Unjust enrichment is a doctrine or a principle which says that refund will be allowed only to that person who has borne the duty burden. So as we were discussing about in eligible person point. So if I have paid the customs duty and I have not passed on the burden to any other person, then only I am eligible for the refund. If I have already passed on the burden to somebody else by charging and collecting the tax from that person, then if I claim the refund, it would be unjust enrichment because I've already collected the duty from that customer. Now I am not a person who will be allowed the refund. It will be the customer who can claim the refund. If the final customer who has borne the duty burden is not traceable, then the law says the amount to be refunded will be credited to the consumer welfare fund. Now, what are the situations where the refund will be given to you and not transferred to the consumer welfare fund? So in all these cases, the refund will be given to the person and not transferred to the consumer welfare fund. First, where the importer exporter has not passed on the duty incidence or interest to other persons. Second, if the buyer is applying, then the buyer has to prove that the buyer has borne the duty burden and has not passed on the incidence. Next, where imports are by individuals for personal use. So since you are personal using, it means you have not passed on the burden. Export duty is paid as specified in section 26. Or you are claiming drawback of duty. Now this is where you have paid duty on import and the goods are now getting exported. In such cases also, you will be given the drawback. Next, the duty or interest is borne by the notified applicant. And last, duty paid in excess by importer before order for clearance of home consumption is given. So in such cases, it is very clear that in all these 7 cases, the burden is borne by the person and hence the refund would be given to the person. Now, along with refund, how much would be the interest? The rate of interest is 6% and the time period for this interest is beginning from the date immediately after expiry of 3 months from the date of receipt of refund application till the date of refund. So we will be allowing you the refund and we will be giving you interest. Interest will start after 3 months from your refund application. If it is not done within 3 months, you will be given the interest. Now, when will the duty of export be refunded? First, goods are returned. So you had exported, but they were rejected. There was some problem. So you are getting back the goods. So export duty is refunded. Goods re-imported within 1 year from the date of export. An application is made before expiry of 6 months from the date on which the proper officer makes an order for clearance of goods. In these cases, the refund will be allowed for export duty. Now, when will the refund be allowed for import duty? So 26A says conditions. Goods are found to be defective not as per specification. The goods are identified as the imported goods. You have not claimed the drawback. An importer exports the goods, relinquish titles to the goods, destroys or render them commercially valueless. In all these cases, the refund will be given of the import duty. Application before the expiry of 6 months from the relevant date, and there will be no refund if the goods are perishable. Now, you have to make application within 6 months from relevant date. What is the relevant date? First, where goods are exported out of India, relevant date is the date when the proper officer makes the order for exportation. Where you have relinquished the title on the goods, in that case, The relevant date is the date on relinquishment. Where the goods are destroyed or rendered commercially valueless, the relevant date is 6 months from the date of such destruction or making the goods commercially valueless. So students, these are the various provisions. Now we'll take up some question answers. So let me take you to the first chapter again. So we are in the chapter on procedures. Now in relation to the procedures, there are some important points. Let us understand the points through these question answers. So Queen Mary is a vessel containing goods imported by XML Limited. The events relating to this import in India and the discharge and onward movement and storage of goods are as follows. First, vessel entered the Indian territorial waters on 24th May. 25th May, the import manifest was given. 27th May, the importer fined bill of entry. 29th May, the permission of entry inwards was granted. Now, the rate of custom duty was increased from 8 to 10% on 28th of May. Now, what rate will be applicable? Students, this is a very important question. Now, out of all these timelines, you have to find out the relevant date. Now, for this, you have to go to section 15 of the Customs Act, which we studied in the previous chapter in our previous class. Over there, it says that wherever you are clearing the goods for home consumption immediately on its import, then the relevant date for determining the rate of duty and also the valuation will be later of two dates: date of filing bill of entry and date of entry inwards. Out of both these dates, whichever is later. So in our example, out of all these dates, the later date between these two dates is 29th May, because that is the date of grant of entry inwards. And since the rate of custom duty has increased to 10%, you will be required to pay custom duty at 10%. Let us see the answer. So you'll also get to know how to do presentation. So see here, they have only given one line answer, but you'll have to explain it this way: that as per section 15, the relevant date for determining rate and value is later of date of entry inwards and date of filing bill of entry. In our case, bill of entry is filed on 26th, entry inwards is granted on 28th, whichever is later is 28th, and by that time the rate was increased, so we'll take the higher rate. Next. Now these are some straightforward theory questions: self-assessment, provision of Customs Act relating to payment of interest, boat notes, we have discussed this. Discuss regarding transit and transshipment. Now students, what is transit and what is transshipment? Please understand. Now, when goods are coming to India, let us take my example. Goods are coming from UK to India. Now these goods, or this vessel which is coming to India, may carry goods for the Bombay port as well as for further ports. Now when it is carrying goods for further ports, let us say Chennai port, Visakhapatnam port, there are two possibilities. First, the same ship will continue and go to the further ports. So first port of calling was Bombay, and from there it will go to further ports starting from Goa, Chennai, Visakhapatnam, etc. First possibility. The same ship carries the goods for further ports. Second possibility, that ship is going to return back from Bombay to UK. It is not going to go to further ports. So what it is doing, it is unloading all the goods at the Bombay port. And from Bombay port, in different ships, these goods are loaded again and sent to the further ports. Now in both these, the first is transit, the second is transshipment. So what is transit? When the same ship which is coming from UK, which first came to the Bombay port, it only unloaded the goods belonging to Bombay port. Remaining goods which it is carrying for other ports is kept in the same ship, and the same ship from Bombay port is moving to further ports. Now in this case, the ship itself will be transiting the goods to the further ports. That is why it is called as transit of goods. In my second case, this ship is not itself going to go to the other ports. So what this ship is doing, it is unloading all goods of Bombay port also and of further ports also at the Bombay port, and that ship leaves. Now this goods which are to be sent to the further ports, they are sent by shifting it, by transferring it to other ships. So this second scenario is called as transshipment. Now in both cases, whatever goods belong to the other ports, since they are not cleared at the Bombay port, there is no customs duty on those goods which are transit or transshipped, because they are not being cleared. No importer is coming there to file bill of entry. So the law says we will allow it to be cleared without payment of duty. Cleared means to be passed further. But the only thing is that we will apply some restrictions, some conditions, so that while these goods are going to further ports, either in the same ship, that is transit, or in another ships, that is transshipment, we want to ensure that finally the duty on these goods is getting paid at the further ports and they are not getting smuggled into India. So for that, the provision under the Customs Act provide for some specific restrictions. It provides for again filing a bond. So the person in charge has to give a bond with a particular amount of security. And once the person delivers the goods to the respective port, and over there the goods are recorded by that particular port's proper officer, a certificate is given. This particular person in charge will produce the certificate at the Bombay port and the bond will get released. Next, brief duty exemption to baggage. We studied this in the baggage rules. What is the relevant date for determining rate of duty and tariff value? I just explained. So it is the later of the two dates. Explain the obligation cast on person in charge. We studied this in 29, that it has to first come to the custom port only, no other port. Again, exception to this is only in exceptional circumstances or where it is compelled by accident or bad weather, only then it can come at other ports. But in that case also, further additional obligations are cast upon it, whereby it is required to inform the custom officer or the nearest police station, and it will not allow the passengers or goods to leave that plane before the officer comes and the officer allows. Again, exception to this is where it is necessary for preserving the health, life of property, it may allow the goods or the passengers to be unloaded. Then second, it has to file the import manifest, import report. Third, it will not allow unloading until unless entry inwards permission is given. Fourth, unloading will happen only at custom designated places. 5, it will happen in the supervision of the custom officer. And 6, you can say one more, that only those goods will be unloaded which are mentioned in the import report. So these are the obligations cast on person in charge. Explain briefly the meaning of entry inwards, entry outwards. So this is the permission given by the customs. Entry inwards is the permission of allowing the ship to unload the goods and passengers it is carrying. Entry outwards is the permission which allows the goods to be loaded on the ship. Which class of importer is required to pay custom duty electronically? Name the dedicated payment gateway. Fine. Now 11. Mr. Anil and his wife, who are non-tourist Indian passengers, are returning from Dubai to India. After staying there for a period of 2 years, they wish to bring gold jewelry purchased from Dubai. Please enumerate the provisions. Now we saw that whenever a person is staying outside for more than a year and coming back, then it is allowed to bring jewelry up to a certain limit. So that will be the answer to this particular question. So answer for 11th question will be, as per rule 5 of the baggage rules, where a person who has been residing for more than 1 year returns to India, it shall be allowed duty-free clearance of jewelry. First, for gentlemen, up to 20 grams with a value cap of 50,000, and for females, 40 grams with a value cap of 1 lakh. So in the given case, Mr. Anil can bring in jewelry up to 20 grams, but up to maximum 50,000, and his wife up to 40 grams with a maximum cap of 1 lakh. Further, in addition to the jewelry allowance, Mr. Anil and wife can also be allowed duty-free clearance of jewelry worth rupees 1 lakh, which is 50,000 per person, as part of free baggage allowance. So we have seen that they have baggage allowance also. So within baggage allowance also, since 50,000 baggage allowance is allowed, so that much also additional jewelry can be brought by them as part of their general baggage allowance. Then customs audit. Now a fishing trawler is operating 10 nautical miles from the baseline. Is it entitled to duty-free stores? Now this is interesting. So when you are in 10 nautical miles, you are within the territorial waters. Are you allowed duty-free stores? Important, duty-free stores are allowed only when the ship is leaving India or it is a foreign bound ship. If the ship is going to operate within the waters of India and is not a foreign bound ship, then there will be no exemption allowed. So this is important. What are the circumstances under which assessment is done provisionally? So we have seen that where the importer is unable to himself do the self-assessment, at that time it may opt for provisional assessment. State the provision for transshipment. We discussed that. Explain the procedure prescribed in custom in case of goods not cleared, warehouse or transit within 30 days. Now see, once the goods come at the port, you have to clear it compulsorily within 30 days, either for your home consumption or send it to warehouse. If you fail to do any of these things, then the law provides for confiscation and then sale of these goods. So your goods which are not cleared from the port within 30 days or any extended time can be then auctioned and sold, and you will lose the goods. So you have to ensure that they are cleared within 30 days. Write notes on Export General Manifest. So Export General Manifest is the document which contains the details of goods that would be loaded on the ship and exported. Boat note, wherever the goods have to be carried in water, that is goods are being waterborne, boat note regulations have to be followed. Next is temporary detention. Now what is temporary detention? So when you are bringing your baggage, let us say you are a foreign tourist. Now your baggage may contain certain drugs. It may contain a pistol. It may contain liquor. It may contain any such thing, the import of which is either restricted or prohibited or is liable to a huge duty. Now, if you have declared this in your bona fide baggage, that is honestly declared in the declaration form that you are carrying these goods. Now, at the port, when you are coming to India, the prohibited and restricted goods will be not allowed to be taken in India, and those goods which are allowed but carrying huge burden of duty, you will be required to pay the duty. Now, in all these cases, the law provides you a, I'll say, relaxation. What is a relaxation? For those goods which are prohibited, restricted in India, you may ask the custom authority to safe keep these goods with them, and when you're returning, you will take back the goods. Second, for the goods which are leviable with very high tax in India at the time of import, you have a choice. If you need them in India, you can clear them by paying that high tax, or again you can again ask the customs to safe keep these goods and return it back to you whenever you are returning. This safekeeping of the goods which are either restricted or prohibited or having huge duty incidents and which were bona fidely declared by you in your baggage declaration form are allowed to be kept with the customs, and you can take them back to your country. This is called as temporary detention. So since you had yourself honestly declared the goods and you are lawfully ready to either pay the duty or you are ready to keep the goods with the customs, the temporary detention is temporarily keeping these goods with the customs, and there will be no punishment imposed on you. But if you try to hide these details at the time of filing the declaration form, and then during inspection these goods are found in your baggage, then they will not be temporarily detained, they will be permanently confiscated, and you will be saddled with heavy penalty. Relevant date for rate of duty. This is section 15. We have already discussed. What is the permissible time limit with respect to following for filing of bill of entry? Now see, technically there is no time limit given in the law for filing bill of entry. But we saw above that you have to clear your goods within 30 days of its import. So impliedly, the time limit for filing the bill of entry impliedly is 30 days. Again, what is the time limit for paying the assessed duty? Again, there is no specific time limit, but you should pay it immediately so that the goods can be cleared. What is the time limit for delivery of arrival manifest import report? In case of aircraft and vessel, it is before the arrival. In case of vehicle which is coming by land, it may be given before or at the time of arrival. What are the provisions relating to filing of arrival manifest? We had discussed. Write a brief note on the declaration made by the owner. So whenever you are coming to India and carrying your baggage, you are supposed to make an honest declaration of all the contents you are carrying in your baggage. If you do not disclose any content and later on it is found during inspection, you will be saddled with heavy tax. State and summarize the provisions and procedures in customs governing preparation of filing of bill of entry. Under what situation amount of duty and interest refundable under section 18 shall be paid to the importer instead of being credited to welfare fund. We studied this in detail. Here the concept of unjust enrichment comes in. State the procedure for clearance of goods imported by post. Now this is a very interesting procedure. So if someone has sent goods by post, so what is the procedure for clearance? So whenever, let us say, a friend of yours who's staying in America has sent you some gift on your birthday and he has used the post route. So in his country in America, he will go to the foreign post office department and he will give the goods to that foreign post office department in his country with a declaration stating the content value of the goods. These goods, when they will be sent by that foreign post office to India, they will come maybe through ship generally or at times by aircraft. And in India, at the port where these goods are coming, they will be given to the foreign department of Indian Post Office. Now, the officer in the foreign department of the Indian Post Office will make a list of all these goods on the basis of the declaration. So declaration the exporter had given in his country, that declaration is also sent along with the goods. Now this officer sitting in the foreign post office department of Indian Post Office will make a list of the goods on the basis of the declaration. Now the list will be whether these are prohibited goods, whether these are allowed with some condition, or whether they are allowed freely with payment of tax. Now for the first goods, the goods will not be allowed to be given to the actual owner. They will be confiscated. For the second goods, if conditions are there, the conditions will be communicated. Now, if the importer is not ready to satisfy the condition, the first and the second goods will be sent back to the original exporter. Third goods, where duty is payable, the duty will be assessed by this officer sitting in the foreign department of the Indian Post Office, and a list will be made of all these goods along with the duty amount. Now, this list will be given to the post office of the respective places to dispatch and deliver the goods to the final person. So, at your doorstep, the postman will come with this parcel and with that assessment slip of the customs, which contains the duty amount. Let us say the duty amount is coming to rupees 2000. If you agree to pay that 2000, you will be given the goods. If you do not agree to pay the 2000 and you are not ready to pay that, the goods will be returned back. The post office will send the goods back to the foreign department, and the foreign department may again send it back to the original exporter. Now, if you decide to take the goods, you'll pay that 2000 rupees, which is the customs duty on that goods, and all this custom duty collected by the post office will be then transferred to the customs. This is the detailed procedure for clearance of goods which are imported by post. Then you may get questions like briefly explain with reference to the provisions of custom all these terms. So you have to put down their definitions and meaning. Now, With reference to the facility, clear first pay later extended to importers under customs law, answer the following question. So this is a theoretical question, you can answer it. Now we come to a practical part. Gregory Pegg of foreign origin has come on travel visa to tour in India. He carries with him as part of baggage the following. What is it? Travel souvenir of 85,000. Other articles carried on 150. 126 of cigarettes of rupees 100 each, valued at 12,000. Firearms with 100 cartridge. Value includes the value of cartridge at rupees 500. So total value is 1 lakh. Now, you have to determine the customs duty. If the effective rate is 38.5, inclusive of social welfare surcharge, and you have to give explanation. Now, you have to see the category of this person and apply the baggage rules. Now see, rule 3 is applicable because the person is a tourist of foreign origin. What is the amount which is allowed duty free? Travel souvenirs and articles up to 15,000, but it will be excluding amongst other things these items. So travel souvenir of whatever value is excluded. Articles carried on person 150, cigarettes 10,000, firearms 25,000. The total is 185. Out of this, up to 15,000 is allowed, so that is deducted. So the balance is 170. On 170, you pay tax at the rate of 38.5. Now, firearms cartridges of firearms exceeding 50 and cigarettes exceeding 100 are not chargeable to rate applicable to baggage. These are charged at 100%, which is the rate applicable to these items. So beyond the specified limit, if you are bringing these items, they will be taxed, but they will be taxed not at the rate of baggage, they will be taxed at the rate applicable to these items. So that is what is the difference. So up to these specified limits, which we saw in that annexures, if you are importing something, it will be allowed to be taxed as baggage. So the baggage rate of 38.5 is applicable. Beyond that, the rate applicable to respective goods will be applicable. Next question. An importer filed a bill of entry after 60 days of filing Import General Manifest. The Deputy Commissioner of Custom imposed a penalty of 10,000 for late filing of bill of entry. Since importer wanted to clear the goods urgently, he paid the penalty. Can penalty be imposed for late filing of bill of entry? Can bill of entry be filed in advance? Examine the issue regarding period available. So, now see, yes, charges are payable for late filing of bill of entry if an importer fails to present the bill of entry before the end of the day preceding the day on which the aircraft, vessel, etc. carrying arrive at the customs station at which such goods are to be cleared for home consumption or warehousing, and the proper officer is satisfied that there was no sufficient cause for such delay. However, the board may, in cases as it deems fit, prescribe different time limits for presentation of bill of entry, which shall not be later than the end of such day. Yes, bill of entry can be filed in advance. It can be presented within 30 days of the expected arrival of the conveyance by which the goods being shipped for importation are coming to India, and this is as per 46.3. In the given case, the time period as described above will be available with reference to the date of arrival of vessel for filing the bill of entry. So this will be our answer to this specific question. Let us proceed further, students. Lakshmi Company imported goods at rupees 10 lakh through a bill of entry presented before the proper officer on 15 December. Now, on which date the custom duty was 20%. The proper officer decided that the goods should be subjected to chemical and other tests, and the same were provisionally assessed at the value of 10 lakhs, and Lakshmi Company paid provisional duty of rupees 2 lakhs at the time. Lakshmi Company wants to voluntarily pay duty of 150 on 20th January. Can Lakshmi Company provisionally pay the duty, and what are the conditions which are to be complied with? Determine the amount of interest payable, if any, under Section 18 of the Customs Act, assuming that the payment of 150 as stated above is made on 20th January and the final duty is assessed on 31st January at 4 lakhs, and the balance duty is paid on the same day. So for this, we have to apply the provisions relating to provisional assessment. So what it says, provisional assessment is permitted in cases where proper officer deems it necessary to subject any imported goods or export goods to chemical test. So answer is yes, Lakshmi can pay the duty on provisional basis. Now, before the provisional assessment of duty, the importer will have to furnish security such that the proper officer deems fit for the payment of deficiency between the duty finally assessed and the provisional duty. Section 18 of the Customs Act further stipulates that the importer is liable to pay interest on any amount payable consequent to final assessment order at 15% from the first day of the month in which the duty is provisionally assessed till the date of payment thereof. So, accordingly, amount of interest payable will be on 15 lakhs at the rate of 15% for 51 days, and on the difference 50,000 at the rate of 15% for 62 days. So this is the delay cost for which you have to pay the interest. Now, after visiting USA for a month, Mr. and Mrs. Iyer, who are Indian residents aged 35 and 40 respectively, brought to India laptop computer at 70,000, used personal effects at 140, and personal computer for 58,000. Calculate the custom duty payable of Mr. Iyer, if any, and ignore the agriculture development cess. Now, as per the baggage rules, an Indian resident arriving from a country other than Nepal, Bhutan, Myanmar is allowed duty-free allowance of use personal effects travel souvenir without any limit, articles other than specified articles up to 50,000 carried in the baggage, and further such general duty-free allowance which can be pooled with the general duty-free allowance of other passengers. Now, one laptop computer when imported into India by a passenger of age of 18 years or above is exempted from whole of custom duty. So that will be exempted. Accordingly, there will be no custom duty on used personal effects worth 140 because that is allowed duty free, and also a laptop computer brought by them. Now, for other things, that is duty payable on personal computer, value is 58, and you are given exemption of general exemption allowance of 50,000. So your taxable value is 8,000. So on 8,000 at the rate of 38.5, the duty comes to 3,080. Next, Mrs. X, an Indian resident, 36 years old, who was on visit to China, returned after 6 months. She was carrying with her following items: personal effects 75,000, laptop 60,000, jewelry 25 grams, which was purchased in China, music system 50,000. Again, we have to compute the duty. Now, here, personal effects fully exempt. Again, one laptop fully exempt. Now, jewelry. Duty-free allowance of jewelry is not available. Why? Because if you remember, we had studied and also solved in previous question that it is available only when the person has stayed for more than 1 year. Here, since she has stayed only for 6 months, there is no exemption for the jewelry part. Music system again fully taxable. So out of all the things, these two are fully taxable. Now in that, you can deduct the general duty-free allowance of 50,000. So the balance taxable value is 75,000, on which the rate of duty is 38.5. So final customs duty is 28,875. So students, these are some questions relating to this chapter. Now we take our break, then we proceed with other chapters after the break. Let us continue, students. We'll first complete the last chapter, that is FTP, and then we'll go to again question answers of the remaining topics. Okay. So now what is FTP? So FTP is basically a set of rules which is given by the government, and the main purpose is promotion of exports and regulation of foreign trade. Now, presently the foreign trade policy which we are right now following is Foreign Trade Policy 2023. Also, there is a handbook of procedures for this, which is also 2023. And then there is IGC HSN classification of export and import items. Now, what are the major promotion schemes as per the FTP? So first is duty exemption. So if you are importing under advance authorization or duty-free import authorization scheme, you don't have to pay duty. Second, duty remission scheme. So whatever duty you have paid at the time of import will be given back to you when you are exporting, which is called as a drawback scheme. Then scheme for remission of duties and taxes on exported goods. So whatever goods are being exported, there will be duty remission on that. Then you can import capital goods without payment of the tax, which is under EPCG. If you are EOU, ESTP, STP or BTP, you are given various concessions. And lastly, there is concession for deemed exports. Now let us understand all of these in detail. So first is advance authorization scheme. So under this scheme, you are allowed to import inputs which you are going to use in export products. So you are going to use them as a raw material consumables in making your export products, and they are allowed duty free. In return, exporter needs to fulfill the export obligation. So generally the export obligation is 6 times of the duty import which is saved. So if let us say you have imported goods on which the duty component which is saved or which is exempted is rupees 10 lakhs. So you have to do export obligation of rupees 60 lakhs. Most important, it is not transferable. So whatever is your scheme benefit, you cannot give it to others. Actual user condition, you will yourself have to use that input. You cannot sell the inputs to others. And when you are using these inputs in your export goods, the value of export goods should be at least 15% higher. That is, there should be a value addition of at least 15%. Next, DFIA scheme. This is also similar to our advance authorization scheme. That is, you can import goods free for the purpose of export. The difference is this is transferable. Again, here there is no actual user condition, and hence it is transferable. But here the minimum value addition is 20%. Then the other schemes, EPCG. So you can import capital goods, or you can even procure them locally, but without payment of duty. And again, you'll have to prove that you have used this in making your export goods. Again, to the extent of duty saved under the scheme, again multiply by 6, you have to fulfill the export obligation. Next, if you are 100% export oriented undertaking, electronic hardware technology park, software technology park, or business technology park, then the schemes are you can import or procure locally capital goods and inputs without payment of duty. Again, you have to use it for export. In return, you have to export your entire production of goods and services, except to the extent permissible, you can do domestic sales. Trading units are not covered. So whatever you are using for trading, that is not covered in this scheme. Next, deemed exports, goods which are manufactured in India and which are supplied to some specified projects or to consumers will be deemed as exports. Goods are not leaving the country and the payment is received in Indian rupees only. That is why it is deemed export and not actual exports. Now under this, there are some important points. some important concepts. Let us understand them. So first question, Ayush Bhandari wants to import samples from US. What is the brief policy for import of samples? So import of samples of even restricted items is allowed without import authorization. Further, few things are excepted to this. Defense items, security items, seeds, bees, new drugs, they will need authorization. Now, duty-free import of samples up to rupees 3 lakhs for all exporters shall be allowed, subject to terms and conditions of customs notification. So these are the various provisions in FTP for samples. Next, what are the salient aspects of advance authorization or annual requirement to exporters? So annual advance authorization would be issued to exporters having passed export performance in at least 2 financial years to enable them to import the inputs required by them on annual basis. Advance authorizations for annual requirements shall only be issued for items which are notified in SION. SION is the standard import-export norms, and not on the basis of ad hoc norm under self-declared authorization where SION does not exist. Annual advance authorization in terms of CIF value will be granted up to 300% of the FOB value of physical export. So whatever you have exported, we will take 3 times of that value, and to that extent, we will give you advance authorization. Or up to rupees 1 crore, whichever is higher. So 3 times of FOB or 1 crore, whichever is higher, is the amount of advance authorization given. Next, Mr. X is desirous to know the benefit of deemed exports under FTP. You are required to discuss the same with reference to FTP. Now, for deemed exports, what are the provisions? Deemed export shall be eligible for any or all of the following benefits in respect of manufacture and supply of goods, qualifying as deemed export subject to specified terms and conditions. What are they? Advance authorization for annual requirement, that is DFI. Deemed export drawback. Now, refund of drawback on inputs used in manufacture and supply under the deemed export category can be claimed on all industry rate of the duty drawback schedule provided no SENVAT credit has been availed by the supplier on the excisable inputs or on the brand rate upon submission of documents evidencing actual payment of basic custom duty. Next, refund of terminal excise duty of specified excisable goods. So supply of goods will be eligible for refund of terminal excise duty provided recipient of goods has not availed SENVAT credit or rebate on such goods. Third, discuss the key similarities and difference. This we have done. Discuss the privileges granted under FTP to status holders. This is very important. So under FTP, there is a concept called a status holder. Once you are fitting in this concept, you are given certain advantages or privileges. Now, what are these? Authorizations and custom clearance for both import and exports on self-declaration basis. So what is the first privilege? That you are given authorization and custom clearance in case of both import export on self-declaration basis. That is, you can do your own valuation, etc. Next, fixation of input output norms on priority. That is within 60 days. Exemption from compulsory negotiation of documents through banks. That is also very important. So you need not involve in bank, and that will save a lot of commission cost. Exemption from furnishing of bank guarantee in schemes under FTP unless otherwise specified. So you are not required to furnish bank guarantee under the FTP schemes. Next, 2-star export house and above are permitted to establish their export warehouses. Further, manufacturers who are also status holders, 3, 4, 5-star, will be enabled to self-certify their manufactured goods as per their industrial entrepreneur memorandum, industrial license, letter of intent as originating from India with a view to qualify for preferential treatment. So those who are status holders of 3, 4-star category, they can self-certify their goods. They need not take the certification from outside. Similarly, status holders shall be entitled to export freely all those exportable items on free of cost basis for export promotion subject to some limit. So export freely means without any restriction conditions. Next, status holders will be entitled to preferential treatment and priority in handling of their consignments by the concerned agencies. Next, we go to 7th. Two exporters, namely Red Sky and Black Knight, have achieved the status of status holder, that is 1-star export house in the current financial year. Both have been regularly exporting goods other than gems and jewelry every year. What would have been the minimum export performance of the two exporters to achieve this status? So indirectly, from this you'll get to know what is the requirement for becoming the status holder. Now, both exporters want to establish export houses in accordance with the applicable guidelines. What should be their export turnover? Now, this will help us understand the requirements for becoming status holder. Now, status holders are export firms recognized as business leaders who have excelled in international trade and have successfully contributed to countries' foreign trade. All exporters of goods, service, technology having an IC number shall be eligible for recognition as a status holder. Status recognition depends upon export performance. Now, in order to be categorized as 1-star, you need to achieve the export performance of 3 million USD, which is FOB, FOR, during the current and all the 3 financial years. Now, the export performance of Red Sky and Black Knight would have been at least 3 millions during the current and all the 3 years, and hence they are given the status of 1-star export house. Now, 2-star export houses and above are permitted to establish their export houses that we saw earlier also. Therefore, if Red and Black can establish export warehouses in India only if they achieve the status of 2-star and above, and in order to achieve that status, the export performance during the current and the previous 3 years should be this. We already saw for 1-star it is 3 million USD. Now for 2-star it has to be 5 million in current and all the 3 years. Similarly for 3-star it has to be 50 million, 4-star it has to be 200 million, and for 5-star it has to be 800 million USD. Fine. Now, next point. Flintex manufacturers manufacture goods by using imported units and supplies the same under the aid program of the United Nations. The payment of such supplies is received in free foreign exchange. Can Flintex manufacturers seek advance authorization with reference to the provisions of FTP or the supplies made by it? So, what is important is they are making the supplies under the aid program of United Nations. Are they eligible? Now, supply of goods to United Nations international organizations for official use or supply to projects financed by them are deemed exports. Advance authorizations can be issued for supplies made to such deemed exports. Therefore, Flintex manufacturer can seek an advance authorization for their supplies. Next, XYZ has imported inputs without payment of duty under advance authorization. The CIF value of such inputs is rupees 10 lakhs. Inputs are processed and final product is exported. Export made by XYZ are subject to general rate of value addition prescribed under advance authorization, which we saw students was 15%. No other input is being used by XYZ in the processing. What should be the minimum FOB value of the export as per the provisions of advance authorization? So advance authorization necessitate export with a minimum 15% value addition. So how your valuation should be? So FOB value of the export realized should be how much? 10 lakhs plus 15%. So it comes to 1, that is 11 lakhs 50,000. Next, A has used some duty paid inputs in its export products. However, for rest of inputs, he wants to apply for advance authorization. Can he do so? Explain with reference to the FTP. So the point or question to be understood is that A has already paid duty on some inputs, and for other inputs, he wants to use advance authorization. Can he do so? So answer is yes. Why? In case part of the duty free and part of duty paid inputs, both advance authorization and drawback will be available. Drawback can be obtained for the duty paid material, whether imported indigenous used in the exported goods as per the drawback rate fix, and advance authorization can be used for importing duty free material. Details about duty paid material must be mentioned in the application for advance authorization. So students, these were some important questions relating to the chapter of FTP. Now let us go to the chapter of warehousing. Now, interest-free period of 90 days under 61(2) in respect of warehouse goods commences from the date on which into bond bill of entry in respect of such goods is presented. Comment on the validity of the statement. Now, if you remember, the first question was for what period goods can remain in warehouse. So answer is if the goods are being kept in warehouse for the purpose of being used in manufacturing operations, there was no time limit. And for other cases, it was up to 1 year. Now, in the first case, where the goods are kept in the warehouse for manufacturing, also there was no interest. But in the other case, that is where it was not for manufacturing operations under section 65, the interest would start after 90 days. Now the question is how this 90 days period is to be counted. Now here the point was that it will be counted from the date of filing the bill of entry for depositing the goods in the warehouse. Whether the question is valid, answer is no. As per section 61, if goods remain in warehouse beyond a period of 90 days from which date? From the date on which order permit for warehouse is made. Interest is payable at 15%. Correct? So, in other words, the relevant date for determining commencement of period of 90 days is the date of order made permitting the removal of goods from custom station and deposit in warehouse, and not the date on which into bond bill of entry is presented. So though there won't be much difference between these two dates, because first you present the into bond bill of entry, and after processing that bill of entry, the order for depositing the goods in warehouse is passed. But still, technically, the statement is invalid, because in the statement it is said it will be counted, 90 days will be counted from the date of into bond bill of entry, whereas the correct answer is it will be counted from the date on which the order permitting the goods to be kept in warehouse is passed. So the time difference won't be much, but still technically correct is this. Next, if manufacturing operations are carried out on warehouse goods, finished goods are cleared for home consumption, an appropriate duty of customs should be levied on the quantity of the warehouse goods containing the waste or refuse arising out of such manufacturing operation. This is what we also saw in the treatment of waste. Examine the validity of the said statement in the context of 65 dealing with manufacture and other operations. Now, the said statement is correct. Section 65 lays down that if finished products arising as a result of operations carried out in the warehouse are cleared for home consumption, that is, they are not exported, import duty will be chargeable on the quantity of the warehouse goods as are contained in the waste or refuse arising from such operations. Next, enumerate the circumstances under which the goods are considered to have been improperly removed. Students, this is a very important question. And what will be the effect of goods being improperly removed? All the consequences of penalty will be applicable. Now, Section 72 provides that in any of the following circumstances, the goods shall be considered to have been improperly removed. First, where warehouse goods are removed from the warehouse in contravention of Section 71. Second, where warehouse goods have not been removed from the warehouse at the expiration of the period during which such goods are permitted under 61. So we had that 1 year time limit. If 1 year crosses, they are deemed to be improperly removed. When any goods in respect of which bond has been executed under 59 and which have not been cleared for home consumption or export and are duly accounted for to the satisfaction of the proper officer. So you had issued bond, we allowed you to keep the goods in warehouse. Now you are supposed to export it or clear it for home consumption. If both is not done and later on the goods are not accounted for, means it is found that the goods are deficient. In that case, again, it will be liable for being treated as improperly removed, and hence the consequential penalty will be applicable. Next. Now, fourth point is Vipul imported certain goods in May into bond bill of entry was presented on 14th May and goods were cleared from the port for warehousing. Assessable value on that date was USD 1 lakh. The order permitting the deposit of goods in warehouse for 4 months was issued on 21st May. Vipul deposited the goods in warehouse on the same day but did not clear the goods even after the warehousing period got over on 21st September, which is of 4 months. Notice was issued under 72 of the customs demanding duty and interest. Vipul cleared the goods on 14th October. Compute the amount of duty and interest payable by Vipul while removing the goods on the basis of following information. First, rate of exchange as on 14th May, that is the date when the bill of entry, the first bill of entry is filed. Then on 21st September and on 14th September. 21st September is the date on which 4 months is getting completed. 14th October is the date when you are finally removing the goods. And then you have basic custom duty at all these dates. Integrated tax is exempt and ignore agriculture and infrastructure development cess. Now here, assessable value is 1 lakh. The first question is the conversion of this 1 lakh. Now in this particular case, if you recall section 14, which is the valuation section, it is saying that for the purpose of conversion, you will take the exchange rate given by CBIC and it would be always on the date of first bill of entry, irrespective of whether the goods are warehouse or not. So first bill of entry, the exchange rate is how much? It is 65.2. That is the date of filing the first bill of entry. So that will be taken. So 65.2. So the value becomes 65.2 lakhs. Now comes the custom duty. Custom duty, students, will be taken as on the date of filing the X bond bill of entry. That is the second bill of entry. So goods were not removed within the permissible time period in terms of section 72. And interestingly, you have to presume that the goods have been removed on the day on which the time limit is over. This is as per Kesoram Rayan. Hence, the applicable rate of duty in such case is the date prevalent on the last day on which the goods should have been removed. So even though you physically removed the goods late, the date applicable is the date on which the 4-month period is over, that is 21st of September. So we will take the duty rate which is applicable on 21st of September, though goods were actually removed on 14th, but it is deemed to be removed on this date. Hence, we'll take this particular date's rate, so it is 10%. So 10% is the tax plus compulsory social welfare surcharge, which is 10% on basic custom duty. So that is added. So your total custom duty payable is 652 plus 65, 200. Correct? Now, as per section 61 of the Customs Act, if goods remain in a warehouse beyond a period of 90 days from the date on which order permitting deposit of goods in warehouse under 60 is made, interest at the rate of 15% is payable on the amount of duty payable at the time of clearance. Now, period of 90 days is started from which date? From the date the order of deposit in warehouse was passed, and from that date 90 days will end on which date? So 90 days, if you start counting from this 19th of August till the actual date of removal, you will find that you have exceeded the 90 days by 56 days. So now interest will be calculated on your total duty payable at the rate of 15% for the excess days, which will be beyond 90 days. So it is running and it is coming to 56 days. So interest at the rate of 15% per annum on 56 days will come to 16,505. Correct, students? Fine. Now, next question. B Limited imported super kerosene oil and stored it in a warehouse. An ex-bond bill of entry for home consumption was filed and duty was paid as per the rate prevalent on the date of presentation of such bill of entry, and the order for clearance of home consumption was passed. So you had kept the goods in warehouse, ex-bond bill of entry was filed, and the duty was paid as per the rate prevalent on the date of presentation of such bill of entry. On account of highly combustible nature of this product, because it is kerosene, the importer made an application to permit the storage of such kerosene in the same warehouse until actual clearance for sale. The application was allowed, however, the rate of duty increased when the goods were actually removed from the warehouse. The department demanded the differential duty. Company challenged the demand whether it will succeed. So, yes, the company will succeed. The facts of the given situation are similar to the case of Commissioner of Customs versus Vico Lorry Limited, 2008, wherein the Supreme Court has held that where duty on warehouse goods is paid, an out-of-charge order for home consumption is made by the proper officer in compliance of provision of Section 68. The goods allowed to be retained for storage in the warehouse are permitted under Section 49 of the Customs are not treated as warehouse goods. So, the moment the order for clearance is passed, they are treated no more as warehouse goods. And since they are treated no more as warehouse goods, hence the provision will not apply. Now, Section 49 of the Customs Act 1962 inter alia also provide that imported goods entered for home consumption, if stored in public warehouse or in private warehouse, on the application of the importer, and if the same cannot be cleared within a reasonable time, shall not be deemed to be warehouse goods for the purpose of this act, and accordingly the provisions of chapter 9 shall not apply to such goods. So that is why, as per 49, it will not be treated as warehouse goods, and hence the provisions will not apply. Let us go to the next topic, the last one for today, that is relating to refund. Now, Messrs. HIL imports copper concentrate from different suppliers. At the time of import, the seller issues a provisional invoice and the goods are provisionally assessed under Section 18 of the Customs Act based on the invoice. When the final invoice is raised based on the price prevalent in the London Metal Exchange on a predetermined date as agreed in the contract between the buyer and the seller, The assessments are finalized on the basis of price in such invoices. Now, Messrs. HIL has filed a refund claim arising out of finalization of the bill of entry by the authorities. The department, however, has passed an order of refund to be created to the fund in the absence of any evidence from HIL that the burden of duty has not been passed. Discuss. So basically, students, the point is that we are here talking about refund. Now, you had earlier issued a provisional invoice, and according to that, the goods were provisionally assessed. When the final invoice is raised based on the price prevalent in the London Metal Exchange on a predetermined date, the buyer and seller, the assessments are finalized on the basis of the price in such invoice. So this is also a case of provisional assessment. Now, since the value has reduced, now you are applying for refund. However, the department is saying, no, we cannot give you refund. We will shift it to consumer welfare fund. Now, the most important point is whether refund should be allowed to you or it should be transferred to the consumer welfare fund. Now let us analyze. So according to section 27, a refund claim should be lodged before the expiry of 1 year from the date of payment. The period of limitation of 1 year should be computed in following manner. If the refund claim is lodged by importer, time limit should be calculated from the date of payment. If refund is lodged by buyer, time limit should be calculated from the date of purchase. In case of goods which are exempted from payment of duty by ad hoc exemption, the limitation of 1 year should be computed from the date of issue. Now, the time limit of 1 year is not applicable if the duty is paid under protest. Finally, it is worth mentioning that above provisions regarding time limits are mandatory and custom cannot grant a refund which is filed beyond the maximum permissible time period. So this is what is the provision. Now, if you apply these provisions, sorry. We are in question 2. So section 18, it deals with provisional assessment, incorporates the principle of unjust enrichment in case of refund, which is arising out of finalization of provisional assessment. Now, subsection 5 of 18 provides that if any amount is found to be refundable after finalization of provisional assessment, such refund will be subject to the doctrine of unjust enrichment. Further, section 28D places the onus on the person who has paid duty to prove that he has not passed on the incidents. In absence of any proof from such person, section 28D deems that the burden of duty has been passed on. Therefore, in the given case, department action is correct if a child does not produce any evidence. So students, it is very important to understand that this section 28D is deeming that the duty burden always passes on. If you say that in your case it has not passed on, it is on you to prove that it is not passed on. In absence of any such proof, 28D will deem that the burden of duty has passed on to the buyer and you will not be allowed to give the refund, and the refund will be credited to the consumer welfare fund. Section 26 of the customs provides for refund of import duty paid if goods are found defective or are not as per specification. Discuss the conditions. We have discussed that above, so I'm skipping this. I'm going to a practical sum again. So question 6, Acme sales imports were being provisionally assessed pending a verification that the department was carrying out. Upon completion of verification, assessment was finalized and Acme sales was asked to pay 12 lakhs, which is paid. After 6 months, upon detailed scrutiny of a verification report and taking legal opinion, Acme filed a claim for refund of 8 lakhs on the ground that the differential amount should be only 4 lakhs. So when they paid 12 lakhs, 8 lakhs was excess, and that was a mistake in the verification report. Was this the correct mode of redressal? What will be the likely outcome of the claim? Discuss basis case law. Now, Acme received an order finalizing provisional assessment on the basis of verification report requiring payment of 12 lakhs. They did not contest the order but made the payment and also allowed the appeal period of 60 days to lapse. After appeal became time barred, now they filed a refund claim in which they are challenging the order. This was a backdoor method of seeking relief against the order. It also asked an officer of the same rank to review the order passed, and it sought to bypass the time limitation of appeal by presenting the appeal as a claim of refund. The Honorable Supreme Court has held in the case of Priya Blue Industries 2004 that such a refund claim is not permissible for all these reasons. A person who's agreed with an assessment order cannot seek refund without filing an appeal. So students, what is important to be noted is once the order was passed, the option which is available to you in case you are saying the order is incorrect, which here your contention is because you are saying it is depending on a verification report, and the verification report is not in your favor, or the verification report has some flaws. So this means you are challenging the final assessment. Now, since final assessment is an order passed under the law, the option which is given by the law to you is to contest that by way of filing an appeal. Now, the moment you say contest by way of filing appeal, the time limit for appeal triggers, which is 60 days. Now, this 60 days time limit was lapsed, and later on, when you realize this, you decided to get the benefit in another manner by bypassing the appeal mechanism, and that you did by filing the refund claim. Now, interestingly, refund claim was maintainable because only 6 months had passed. But the question that the Honorable Court had to answer is that once an order is passed, and if you are not satisfied with the order and if you believe there is a mistake in the order which you want to challenge or contest, can you directly find the refund and then in the refund you can challenge the order? The answer is no. The Honorable Court opined in this particular case that since your case is for challenging the order, because why you are filing a refund? Because indirectly you are saying the order of final assessment was wrong. The order should have been of 4 lakhs. So it means you are challenging the order. Now, since you are challenging the order, the mechanism provided in the law is not to file refund application, but to file an appeal. Now, for filing appeal, you have to follow the statutory timeline, which is of 60 days. Since it is missed, hence, if you are now trying to bypass that by using the refund route, the refund will be not allowed. So this is a very important and a very good judgment analyzing the comparison of refund versus appeal. Next, Mr. N has over 3 consignments of 200, 400 and 400 units, imported a total of 1000 units of an article ZEP, which had value of rupees 1150 per unit. Custom duty was assessed at 250 per unit. He adds his profit margin of 350 and sells the article for 1750. So 1150 is the value. You add 250, so it becomes 1400. You add 350, it becomes 1750. It means you are recovering the duty component by adding it in your price. This is very important. Now, after 1 month of selling the entire consignment, Mr. N found that there has been an error in payment of duty, in which duty for the consignment of 200 was paid as if it was 400, resulting in excess payment of duty. Mr. N files an application for refund for the 200 excess. So you had removed 200, but you paid or computed duty for 400. So now you are filing the refund for that excess 200 duty which you have paid. So it will come to how much? 200 units excess into the 250 rupees duty, so 50,000. Now the question is whether there will be the restriction of unjust enrichment. Again, this is an interesting point, students. Now you have to understand that whether have you recovered this duty from your customer. One thing is very clearly shown in the question that you are adding this 250 in your sale price. But here, if you analyze the question, there is one very important point that you had 3 consignments, 200, 400, 400, total 1000. But when you are assessing that 200 units consignment, while computing duty, instead of multiplying it by 200, you multiply it by 400. So you have paid duty excess on that 200 units. Now the question is that burden passed on? If you understand this question thoroughly, you will find that that burden would not have been passed on, because I have totally cleared 1000 units and I have paid duty on 1000 units. I've sold 1,000 units, but if you see the duty calculation, you have paid duty not on 1,000 units but on 1,200 units, because one of your consignment, which was 200 units, is wrongly calculated taking 400 units. So you have paid duty on 400, 400, 400, that is 1,200. Now this 200 units duty which you have paid excess, mathematically that you have not recovered. Why? Because you have not sold 1,200, you have sold only 1,000. So for this 200 for which you have paid duty extra, you have not recovered it, and hence this should not tantamount to unjust enrichment. So Mr. N's invoice show that he collected duty of 200 rupees per unit, and this he has done on 1,000 items. However, he has paid duty on 1,200 items, that is 200 items more. Why? Because the first consignment was of 200, but he calculated the duty taking 400. So 400, 400, 400. So effectively he paid duty on 1,200 units. Now this payment in the normal course was made before the order permitting the clear of goods. It would be evident from the bill of entry that the amount paid was more than the amount assessed. So there is no doubt in that. Thus, N case fall within the exception to unjust enrichment linked, that is clause G of the first proviso. He will be able to refute the charge of unjust enrichment. Why? Because he has paid tax on 1,200, whereas he has got 1,000 and he has sold in market 1,000. So yes, he has recovered duty from the market, but that is only of 1,000, not of this 200. So he will be able to refute the charge of unjust enrichment. Further, clause A of the same subsection provides that the doctrine of unjust enrichment will not apply to refund of duty and interest, if any, paid on such duty if such amount is relatable to duty and interest paid by the importer if he has not passed on the incidence. Now, definitely, since I have sold 1,000, I have passed on the incidence only of 1,000 units, not of 1,200 units. Mr. Any invoices and other documentary evidence will show how much duty he collected from his customer. Hence, he may be covered by this clause also to escape the bar of unjust enrichment. In short, the refund will be allowed. Next, let us take up one more question, students. Explain the relevant days as provided in 26A2 of Customs Act 1962 for the purpose of refund of duty under specified circumstances, namely export of goods, relinquishment of title, goods destroyed or rendered valueless. Now, we all are given time limit to apply for refund, and that time limit is to be counted from a relevant date. So the time limit is 2 years, but 2 years has to be counted from a particular date, which is called as the relevant date. Now, what is this relevant date? That is what is the question. Now, what is the relevant date? Where you are exporting the goods, and this is leading to refund. So in case of refund arising from export of goods, the 2 years will be counted from which date? It will be counted from the date on which the proper officer has made the order permitting clearance and loading of goods. So the date on which your shipping bill filed, after that the officer assesses the shipping bill and pass the order permitting the loading of the goods. That order's date is the relevant date, and from that 2 years is the period for applying refund. Next, relinquishment of title. So where at the time of import you have relinquished your title, and before that you had paid the duty. So now you want refund. So the 2 years will be counted from the date on which the title was relinquished. Next, goods being destroyed or rendered valueless. If again after import for some reason the goods were not appropriate, so you decided the option of destroying it, and since you have destroyed it, now the import duty becomes refundable to you. 2 years will be counted from which date? It will be counted from the date of such destruction or rendering the goods valueless. Correct, students? So this is how relevant date will be counted as per explanation to the refund section of 26A. So with this, students, we complete all the topics. So we have completed the entire part in complete details, the academic revision part also, and plus the practical part also. I'm sure this will help you a lot in your preparations. So with this, I conclude today's session. Let us connect again on Saturday for dealing exclusively with the statutory updates. Till then, kindly study, and in case you have your doubts, you can come up with your doubts in the upcoming session, which will be our last session for this LVRC classes. With this, let us conclude today's class. Thank you very much. Take care. Bye bye.